Hello and welcome to Accounting 2208 Tutorial 17.1. This tutorial will illustrate earnings per share using the Simpson Company example. The data for this tutorial is short enough for us to include in it rather than have to refer to it separately. Still, it's a good idea to print it off and have it available for you to refer back to. So we have a number of things to look at here. We have a convertible bond. So remember, we're going to have to, in our diluted calculations, is capture any individual impacts of any potentially diluted items. We're given what our number of common shares authorized and issued are. We have preferred shares that are cumulative, and they're convertible into common shares, so we'll have to deal with that. There's in contributed surplus, we have some warrants, and the warrants can be converted into common shares, so we'll have to deal with that as well. And the other thing that we know is that during the year on February 1st, some shares were issued, and there was a 2-for-1 split, so we have to account for that. And the company had $360,000 in income, including an after-tax gain from discontinued operations, so the hint is we're going to have to deal with that. And we're given a tax rate, as well as a common share value of $42, adjusted for the split, so we don't have to worry about converting it to account for the split. And that's going to be necessary for us to deal with anything like stock options, warrants, or rights. And so our required is simple: calculate the appropriate EPS. And we'll do that for basic and diluted. So let's just quickly summarize what we have here. We've got 8% bonds. We've got each bond that's valued at $2,000 and is convertible into 25 common shares. So from the data, you saw that the value of the convertible bonds is $400,000, and they have a face value of $2,000 each and convertible to 25 shares. So that would equate to 5,000 additional shares before the stock split, and of course, accounting on a 2-for-1, that means that that could add an additional 10,000 shares to our base of common shares. We'll also look at how preferred shares could affect us. So we know that there were 5,000 preferred shares issued. Each share is convertible to 2 common shares, so that's what this is. So before the stock split, presuming that means if there was no stock split, that could add an additional 10,000 shares. However, because there was a 2-for-1 stock split, that now leads to an additional 20,000 common shares if converted. And last but not least are the warrants. So in contributed surplus, there are 300 issued warrants, and each warrant has the right to purchase 4 shares. And so on a pre-split basis, that would have added potentially 1,200 shares if exercised, but now multiplied by 2 means that there are 2,400 potential shares if those warrants are exercised. Okay, so the first step in getting to our EPS is to determine what the weighted average number of common shares is going to be. If we don't know the number of shares, we can't determine what the earnings per share is. So we always calculate our weighted average earnings per share. Sometimes we call it WACS, based on the opening balance that we have. So from the data, there were 16,500 shares. And because there was a stock split that happens, we have to compensate for the split. So that's why there's an additional 16,500. So adjusted for the split is 33,000 shares. And all of those shares were outstanding from the beginning of the year to the end of the year because they were there on January 1st and they're there at the end of the year. So that's why the weight is 12/12. So that gives us 33,000 shares. The next up, on February 1st, there were 3,000 shares issued. This is still prior to the stock split, so we have to apply the stock split retroactive, so times 2 gives us 6,000 shares. And because those shares were issued on February 1st, they were outstanding from February till the end of the year. So that's 11 out of 12 months for 5,500 shares. Nothing else happened after that. There were no additional shares issued or repurchased. These already adjust for the stock split, so we don't have to worry about any more calculations. If you need more practice with weighted average common shares, make sure that you find some other problems that have more detailed ones, or you can always make them up yourself. But anyway, after accounting for the split and the additional shares issued, we have 38,500 common shares outstanding on a weighted average basis. Okay, so now we start working on the numerator to help us calculate our weighted average common shares. So we start with our income, right? The 360,000 is the net income. However, we have to subtract $20,000. That was the gain, after-tax gain on the discontinued operation. Right? We have to separate the DO in order to get our basic earnings per share. So we subtract 20,000, so that gives us $340,000 before the discontinued operation and $360,000 after the DO. Now we look at the dividend entitlement. We have cumulative preferred shares. There are 5,000 shares. The company started out with 5,000 shares, and there were no additional shares issued, and they pay a $3 dividend. And that $3 dividend equates to 15,000 in total dividends. There's no indication in the problem that the dividends are in arrears. However, even if they were in arrears, you would still only include 1 year's worth of dividends on cumulative dividends. Okay, and that's a common mistake. So some students read through problems and see that they're 3 or 2 years in arrears, and they'll double this up. No, that's not the case. Okay, so our income available to common shareholders before the discontinued operation, 325, and 345 after. Okay, so now once we've figured out what the weighted average number of common shares is, and we figure out what the basic EPS is in the numerator, we can now calculate our basic EPS. Basic EPS is equal to our $325,000, and this is already after the entitlement, right, of the preferred shareholders or the preferred dividends, divided by 38,500 shares. This gives us $8.44 per share EPS. And so this now is going to be our comparative number to determine whether any of the other items are dilutive or not. So the next step in determining the individual impacts of dilutive items is to always start with any stock options, warrants, or rights. It doesn't matter how they differ. The point is that all of these are always the most dilutive. Always the most dilutive. Most dilutive. Always. But if they're in the money. In the money. And in the money means basically that there's an incentive to exercise the shares. In the money is that the exercise price must be less than the market price. So exercise price has to be less than the market price. Otherwise, there is no incentive to exercise the warrants and take the shares. So we have to determine if the warrants are in the money. And how we do that basically is to figure out, well, what is the price per share? So what we have is prior to the stock split, we had 300 warrants that can be exercised into 4 shares. So that's where this 1,200 comes from. So 1,200 at a price of $35 gives us a value of $42,000. Okay. Now, on a split basis, when you have a stock split, you double the number of shares. So 2,400 is 1,200 times 2, but the share price gets cut in half. So this 1,750 is $35 divided by 2. Right? 35 divided by 2, if I can get that right. Okay. So 1,750 times 2,400 is still $42,000. So these should be the same before and after. So what we have is a post-split market price, sorry, a post-split warrant price or exercise price of $1,750. And the market price that's given is $42. So therefore the warrants are in the money. Okay, the exercise price is 17. If you could purchase a share at 17 and that share is worth 42, you'd be crazy not to take it. And so that is dilutive. And as long as they're in the money, they are always the most dilutive. So number one, in terms of factoring into our diluted calculations, warrants, rights, and options always come first. If there are more than one of them, it doesn't matter the order because they're all fully dilutive anyway. Okay, so now that we know that the warrants are in the money, we have to figure out what the impact on the number of shares is. So what we do is we say there are 2,400 post-split shares that would, post-split shares that can be exercised at $17.50. So the proceeds on the exercise will bring the company $42,000. Okay. Now, students are okay with this part, but the next part they kind of forget. What happens next is we use the treasury stock approach. That's why this is in the treasury stock. Sometimes you may see reference to this being the free shares approach. I don't know if you ever see that, but free shares. Okay. But basically, the assumption is, now whether or not this is realistic doesn't matter, but the assumption is the company will take the $42,000 and go back on the market and repurchase some shares back. Why they would do that or why we make that assumption, I don't know. I don't know that it necessarily makes sense, and it really isn't the most conservative, but it is what it is. So 42,000 divided by 42 shares, right, is 1,000 shares that would be repurchased. So the company is going to issue 2,400 shares, so 2,400 new shares, and buy back 1,000 shares, so repurchase. So that means that the excess number of shares between the rights and the repurchase is 1,400. So 1,400 shares is going to be added to the number of common shares because 2,400 new ones will be issued at $17, bringing the company $42,000, which will turn over and use to repurchase 1,000 shares at $42 a share. Okay, so now that we've dealt with the most dilutive item, we'll look at the other convertible. There's a spelling here, convertible. Bonds. Now it doesn't matter if we look at the convertible bonds or the preferred shares, one can come after the other, it doesn't matter. We'll determine the order of dilution after we've done them all. So what happens here is bonds pay interest, and if the bonds are converted into common shares, then the interest is avoidable. So we have to determine how much interest is potentially avoidable if those shares are converted. So what we have are bonds with a total value of $400,000. And that is given in the original data. Okay, we presume that these are at par. We don't have to worry about premiums and discounts or anything like that. They pay 8% interest. Okay, that's the annual rate. Now, we're multiplying by 12 out of 12 because these bonds were outstanding at the beginning of the year and outstanding at the end of the year. And we presume that conversions take place at the beginning of the year. So we're prorating this on the basis of 12 over 12 months. If the bonds were converted, let's say on March 1st, then we would only have 10 out of 12 months because January and February would have been removed. And then we multiply by 1 minus the tax rate. So the tax rate is 30%, so we have a 70% after tax rate. So if those bonds are converted into shares, we would save $22,400. And that would result in an additional 10,000 shares. You recall we went through the exercise of saying that there were 5,000 shares that could be converted, but then they were split, so 10,000 shares. So if we take 22,400 divided by 10,000, that's $2.24. And then what we do is we compare that to the $8.44 basic EPS calculation to determine whether or not it's dilutive. And it is, as long as this number, our individual impact, is less than the basic EPS, so this is the basic, it's dilutive, so we're okay. Now, the fact that it's the third most dilutive, we'll talk about that after we flesh out the rest of the slide. Okay, so after the bonds, now we have the preferred shares. Again, if preferred shares are converted into common shares, then the dividends are avoided. And so, potentially, if those shares are converted, there's a $3 dividend and 5,000 shares. That means that there's $15,000 in dividends that are potentially avoidable, right? And if the conversion of preferred shares into common shares happens, remember that each preferred share is convertible into 2 common shares. So that's where the 20,000 common shares comes from. Then if we take $15,000 divided by 20,000 common share, gives us a value of 75 cents. And that 75 cents is less than $8.44, so it's also dilutive. Now, in terms of why this is number 2 and this is number 3, remember that warrants, options, or rights are always the most dilutive. So the warrants are number 1 always. Then we start going to determine the order, and this is important because the order of dilutive impact tells us in what order we have to bring these back in the calculation of our diluted EPS. If we don't do this, then our diluted EPS calculations could be wrong because we could end up including an item that becomes anti-dilutive. So where the individual impact is actually more than the subtotal diluted earnings per share. And we'll look at that when we get there. So the smallest of the 2 is 75 cents. That's why it's the next in order. So that's why it's number 2. And then because 225 is greater than 75 cents, that's why this becomes number 3. So now we can proceed with our diluted EPS calculations. And we do that with a summary table. This is very helpful, and if done correctly, is virtually foolproof. So our table has a numerator and the weighted average number of shares, which is the denominator over here. And this example shows, as with some of the others, shows what the numerator is before and after. So this is before the discontinued operation. This is after the discontinued operation. And the difference between the two is simply how much EPS is on the deal, and we'll see that with final presentation. So we always begin with the basic EPS. And so our basic EPS before the discontinued operation was 325,000. After it was 345. The weighted average number of common shares is the same regardless. And now we're able to calculate $8.44 EPS basic EPS before the discontinued operation, so basically from continuing operations, and $8.96 on net income. Next, we bring in the most dilutive items, and the treasury stock items are always the most dilutive, and the warrants were number 1, if you recall. And they're the most dilutive because options, warrants, and rights add nothing to the numerator. There's no amount of dollars that are saved. All they do is increase the denominator, so they're fully diluted that way. So recall in our calculation that between the issue of shares, the 2,400 shares issued if the warrants were exercised, so 2,400 minus the 1,000 shares that were assumed to be repurchased on the market, this adds another 1,400 shares to our denominator. And so after the conversion or the exercise of the warrants, and remember, diluted EPS presumes that all this will happen. So our income numbers are still the same, but now we have potentially 39,900 shares, and that equates to $8.15 on our continuing operations and $8.65 on the discontinued, or sorry, on our net income. And the difference between the two would be what the impact the discontinued operation had. This step here of creating a subtotal is very important. So after every item that gets entered back in, we create a subtotal because we want to make sure that at any point this subtotal is less than the original basic EPS. As long as it's less, we're okay. If it ends up being greater, then we made a mistake and included an item that is anti-dilutive. So with every step, this number should keep getting smaller and smaller. The next item we said we'd add back in is the second most dilutive item, and that was the convertible preferred shares. And remember that that was 75-cent individual impact, which was less than $8.44. And so the savings of the dividends gives us an additional $15,000 available in earnings, and we put that in both columns, the before and after. And that would give us 20,000 shares. And recall why it's 20,000 shares is because they're originally 5,000 convertible to 2 shares, and then double again because of the split. So that's how this is 20,000 shares. So a new subtotal, right, gives us $340,000 on our continuing operations, $360,000 on net income because the discontinued operation adds 20,000. The new number of shares is 59.9. So if I take each of these and divide by, sorry, I'll do this one in red. If I take the 340,000 and divide by the 59,500, then I get $5.68. If I take the 360,000 and divide by 59.9, I get 601. Again, notice that 568 is less than 815, and this 601 is less than 865, so the number's getting smaller. And so now we have enough information to show what the final presentation would be on our income statement, because we have to disclose this stuff, right? So what we would have would be 2 columns. One would be for basic EPS, and one for diluted, right? And we have income from continuing operations. So income from continuing operations, and this is $8.44. And on then we would have the discontinued operation, discontinued operation, and then net income. So $8.44 And then on the discontinued, then on net income, $8.96. And we know that net income plus or minus the discontinued operation must equal, income from continuing operations plus or minus the DO equals net income. So if we back calculate, we'd find that this is a difference of 52 cents. Okay, 0.52. Now we can confirm that this calculation is correct because our discontinued operations had $20,000, right, in after-tax income. So after tax on the DO. And there were 38,500 shares. So $20,000 divided by 38,000 shares is 52 cents. Now I can complete the presentation on my diluted EPS. On my continuing operations, it's $5.18. On my net income, it's $5.47. And so the difference between these two is 29 cents. And we can prove this 29 cents by the same $20,000 on the discontinued operation, but now divided by 69,900 shares, and that is 29 cents. And so this gives us our full presentation of basic undiluted EPS as it would appear on the income statement. Finally, we bring back in our next dilutive item. This was number 3. This was the 8% bonds, and it added 22,000 in saved interest, 22,400 in avoidable interest, and added 10,000 shares. Now this is the last item, so our last subtotal is the last total we need. So from the subtotal $340,000, we add 22,400, giving us a new total of 36,362,400. On the discontinued operation, or on net income, that gives us a total of 382,400, and our new number of common shares is 69,900. So this number pops down a little bit now. Our EPS, our diluted EPS on continuing operations is 518, and the diluted EPS on net income is 547. And that concludes our tutorial on earnings per share. I hope you found it useful. Please make sure that you review other examples and see how things differ, especially with regards to the calculation of a weighted average number of common shares and the proper order of entry of the individual impacts.